Okay, hello traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, March 3rd. Mike Boutros with you on the wires. Hey, Ted, Peter, great to see you back in the room. Patrick, March, and Jay, man, great to see everyone here this morning. So, lots to discuss. We're at an interesting inflection point. The dollar coming back into the lows that we set on a swing last month, 97.30-ish, kind of where we're holding. The SPX, really strong rebound. Obviously, one of the largest single day rallies that we've seen. Well, the largest single day rally in history on the major US equity indices, but seen some pullback here today. Don't think we're quite out of the woods yet. On the menu, we'll go over the levels for SPX obviously today, but we'll hit DXY, Euro, Dollar Swiss, Dollar Yen, Sterling, Dollar CAD. We got the BOC on tap tomorrow, and then non-farm payrolls and Canada employment on Friday. And we'll also hit the commodities for crude and gold. Let me know if there are any other questions or trade setups you want to review. Hi, Michael. Can you please see Euro Swiss? Looks like it's trying to correct. Interesting cross. I haven't looked at Euro Swiss in months, Marcin. We'll definitely take a look. Sure. I got you. Any other questions or trade setups? Feel free to throw them on the message board. Let's jump right in. So real quick, here's what the DXY looked like last night. Give you guys a whole update on this. We've been following this chart on the weekly. You guys have all seen this on Daily FX and here in SB for months. So the level in question is 97.37 on a closed basis. And then you have this longer dated slope down here off the lows they made in June and September of 2018. That caught the low literally in January. So levels are pretty clear. If we were to buckle back above 97.87 on a weekly close basis, I do think that there would be a little bit more room for a dollar correction in that scenario. All things held constant, we're still working with the reversal. We're just coming off of uptrend support here. Here's what the intraday chart looks like. Okay, so the daily, there's the break of support. There's the reversal off the upper parallel. We talked about that yesterday. And here's that low. So this is the objective February opening range low. It's the objective February open. And you can see on a closed basis, we still haven't approached it. Just lower, 97.12. You got that 786 retracement of the entire advance off that low we made in December, and also the low that you made both in October and November of last year. So really nice pivot in price. That's your next downside sort of target on a continuation. 97.87 is my line in the sand. If we get through that, we could see a larger correction before we move down again. So that's why for me, it's sort of an inflection point here. I really want to see how this is going to pan out, specifically on the dollar index and euro. Here's what it looks like on the intraday. And this is what we looked like last night. So as we noted, these two levels, 97.37, 97.71, we're looking for possible inflection off of one of these levels. So last night, yesterday, last night we probed down into that region. And that was the low. We actually didn't make a deeper low than that. We held that, and here's a little bit of recovery. So again, watch resistance here. If this breaches your upside targets as far as areas of exhaustion and targets on the upside if we break 98.18, 98.45, this is our bearish inval. Okay, so below 98.45, we're essentially looking for a larger recovery to sell. As it stands right now, man, you're coming off the range lows for the month of February. Any questions on DXY? So even if this thing were to recover as high as 98.45, I hope it doesn't get that high, but let's say it does. You're still within the confines of a simple break of support, check of resistance, and move off, right? So keeping things in perspective. Now, it is going to be an interesting day. A quick tidbit, I wanted to take a quick couple of seconds, just talk about what's been going on the I guess this is the fundy section of our webinar, but listen, we had a G7 emergency meeting today. These meetings are not very common. In fact, if I remember correctly, there's only been like 3 prior to this one. 9/11, there was an emergency G7 meeting for the financial crisis. 2007, there was an emergency meeting. And I believe the last one was when Russia was annexing Crimea or something to that degree. there was another one. So they came out today with an emergency meeting on Corona. Nothing really new was announced, but you did see them continue to repledge that they're open and poised to use all policy tools necessary. Again, lack of clarity, lack of any type of meaningful specific implementations, but you've already seen the markets are running with the notion, with the concept that the Fed's going to cut aggressively. In fact, I showed you guys this yesterday. If we look at Fed fund futures as it stands right now, we're still looking at markets pricing in a 100% probability that the Fed will cut 50 basis points, not 25. We're at $1.25 to $1.75, or $1.50 and $1.75. They want to drop down to 1 to 1.25. So my point in bringing this up again is that, guys, markets are largely pricing in an aggressive stance. The risk at this point is a disappointment in a tighter cut, meaning they cut 25 basis points, or even worse yet, they don't cut. In those types of scenarios, expect risk to spill aggressively, because what we've seen over the last 24 hours since the start of the week with that rally yesterday, right, and some of this easing in broader market sentiment is that, okay, the Fed's going to come to the rescue. Powell's already prompted the market saying that they're ready and poised. Here's 50 basis points the markets are pricing in. Now, the argument that's rising immediately today, as I was doing my research to start off the day, is that there's a lot of people calling for an emergency cut, meaning before the next March 18th Fed decision, that they might come out and cut rates aggressively with an emergency cut. Whether that happens or not, guys, we can't trade that. We can't plan to trade around that, and we can't try to, forecast that. At the end of the day, the markets are pricing in that easing, and the magnitude of the easing is going to be the question, right? If they ease lesser than expected, that's the risk to the market. If they come in right at 50 basis points, I think you get a small bump, and then we'd have to recorrect and see what the market pricing does afterwards. But that's what the markets are sort of relying on at this point. So all that out of the way, G7's out of the way. We got the pledge from all central banks that they're going to do whatever it takes, quote unquote, all policy tools, right? Thanks. It doesn't tell us anything new. So for the dollar, the drop that we've seen is sort of the repricing in interest rates. Obviously, the threat and the broader risk. Here's the next major support target, 97.12. Look for a reaction there if we get it. Non-farm payrolls on Friday, guys. Don't forget, into the first week of March trade. Any questions here on DXY? All right. So that's number one. Number two, here's what Euro looked like earlier this week. So the major focus right into the open of the week. You guys know this is the weekly chart. We've looked at this before. The turn. Iman says, I'm in a short trade, 111.76. Appreciate your update as always. I got you, Iman, and I like that trade. Here's what it looks like on the weekly. You guys saw this yesterday. Whoops. Big support zone, okay, that we turned from. Here's the rally. What I tell you guys yesterday in the webinar, the major level of resistance, the pivot, if you will, the bearish invalidation, whatever you want to call it, key resistance, 111.86 into 112.08. We just registered a high at 111.85. Okay, so could curb the upside, could limit the top side near term, could get some kickback from it. Eventually, inevitably, ultimately, we are favoring the topside breach. But from here, yeah, definitely could see a little bit of a kickback here. If there's going to be a kickback, this is the level to look for. Basic 618 retracement. Okay, now we've made a new low, so I don't want to stress this red one here. This is the real. Whoop. Hold on one sec. This is what the retracement would look like now. So 618 from that drop all the way to low we made this year is right here at 1186, 1187. I'm sorry, 1187. 111.70 is the 618 the near-term drop. This is the larger 618 of the advance off 2017. It's the same pivot we've been working with. So both of those get a little bit tighter, right on slope resistance, 1 point, 2 point, 3 point to the start of the year, converges right here, right now. Okay, that's the weekly chart. So we need a weekly close above 1170, 1186 to get this thing going. Here's what it looks like on the daily chart. All right, so let's go ahead and adjust this retracement. Okay, bring that down. $11.86, $11.70, $11.87. Key resistance, there's that upper parallel, 3-point touch confirms right in there. If we're gonna get some kickback, E-man, I'm right with you. This is where you'd expect to see it. Okay, now the first level I'd look at, and you know me, I'm just objective lateral levels would be the February open. That's almost exactly where we just bottomed on this last stretch. So watch that level, E-man, near term. Here's what the intraday chart looks like. All right, so again, let me just adjust this. Okay, so here's the intraday chart that we've been following. Here's what it'll look like right into the start of the week. Okay, we were trading right here below this parallel. So we gapped higher. 1063 was the level that I was focused on. And that's kind of the breakout zone that I was warning you guys on. If we get a 1063, look for a bigger reaction there. Boy, did we get it. 1063 broke, ruptured right through. 111.09 soft target, 111.87. Again, we just peaked at 11.85. So readjustment of that 618, again, keeps 1170 in focus. But on this near-term approach, here's the monthly open that we just talked about. What is that here? 1094. So let's just drop that down to 1094 as a soft target, right? But if we break below that, E-man, a basic retracement is how we're going to want to do this. Let me clean this up. Bear with me 1 second, okay? Let me just see what this looks like. Okay, we can drop this too. All right. Again, I wish, as I was telling you guys yesterday in the webinar, I kind of wanted to see some structure on the advance. We don't really have much slope to work with. So I would say at this point, man, for that specific position, watch for the market US Open at 9:30 and its relation to the February Open at 110.94. If we break below, look for a move back into weekly open support. That's 110.45. The 38.2 is 110.30. Look, this 15 pip range for me is what's going to matter near term. If we break below 110.30, I think you're risking a larger correction off of this key resistance. Remember, right? This is multi-month slope resistance. Again, we favor the upside breach ultimately, but on the initial approach here with what markets are doing and the broader volatility we've seen, I wouldn't be surprised to see a larger setback. So looking for a reaction down at 110.30. If we get it, that would be an area of which, if it holds, we'd be looking for possible exhaustion. Maybe fill the Sunday gap would require a move down to like, where would we close? We close at 110.25, maybe 5 pips lower to fill that, and then a resumption. But that's sort of the game plan for Euro. Definitely was a beautiful spot to find some resistance. I love your entry on that. Man, I'm assuming you took that against the high, which was kind of a go-to move. Watch for initial reaction at the monthly open from February. If we get below that, Weekly open support comes in 110.45. E-man, does that help? Any questions? Says, thank you, Michael. You're more than welcome. Nice entry. Well done. Yeah, there's just no slope to work with on this thing. So we'll have to reassess. On a breach, by the way, you have the August highs, which come in at 112.50, but the next major upside target, you're looking at like 128, 112.80s, 112.99, basically the 113 handle right up here. It's all about this pivot. That's the broader bearish inval. All right, so spent a little time on there on the euro, but I think it's a very compelling setup at this point. We've been super bullish, but at this point, yeah, 1186 into 112 still going to be a region of which you want to respect as not only lateral resistance, but also slope resistance. Okay, number 3, let's hit dollar Swiss real quick. Here's what Swissy looks like. Yesterday, I just wanted to highlight that we were coming into a major support target. Big zone, basically at the September low. So weekly charts not so compelling. There's not much, to write home about here. Where's dollar Swiss? Right here. Just highlighting resistance at 96.70. The 618 of the broader 2018 rally is 95.88. This is really just what I want you to focus the weekly close on. If this is in fact a break below the yearly opening range, it would certainly put a pretty dominant bearish bias back in play on dollar Swiss. So we'll want to see the weekly close below 95.88 to get this thing sort of affirmed on the downside. That's the weekly chart. Daily chart looks like this. Readjustment of some of our slopes that we've been working with. A little bit of a poetic license here with as far as sort of the gradient, but man, September 2018 low, lower parallel for this pitchfork, right in play. If you see a formation like this, guys, where I don't want to get too into the weeds here, but basically what I want to say is if you add on fib levels to the exterior of the pitchfork, so this is a 123.6, you can go 138.2, 1618, obviously, but you can see that the 1236 literally almost caught those lows late last year and early this year on this formation. So leaving that on there, at the end of the day, here's the September low, okay, 95.42. We registered a low yesterday, I think just pips off that. The low was 95.43, okay, so pip off. And then you have the 618 there, which is where we closed. So again, even on a daily close basis, we haven't broken 95.88 yet. We closed right there yesterday. I told you guys in the update. It's exactly where we closed. So watch the daily close. Key support near term, 95.42. If you see a break below that, it's likely going to be a cascade, accelerated move. We've already seen an accelerated move. That being said, the immediate downside bias is at risk here. So it's very similar to what we're looking at with the euro, right? Could see a little bit of a rebound, could see a little bit of a kickback in the euro. Bearish invalidation is 96.70, 96.73. So as long as we stay below the median line, essentially, I still favor the downside, but the risk for a little bit of recovery is there. Here's what it looks like on the intraday. Okay, there's 96.71. It's actually the objective yearly open, okay, for the 2020 calendar. Converges on basic slope resistance off the highs of the year. There's the median line for the pitchfork that we're looking at in the daily chart. It all converges right here. That would be your bearish inval. So the immediate focus, again, you've been marking some divergence into the lows, not interested in shorting into support, right? Not interested in shorting into 95.42. But if we get a nice little rebound, might get a better entry closer to 96.70s for an entry. If you're thinking to yourself, Mike, would I play the long here? I don't see, no one's asked that yet. I was waiting for someone to ask that, but just to throw it out there for you. If you do, you want to wait for a pretty compelling signal. The stop would need to be against 95.42. So you're already like, 30 pips off that. So a little bit too rich for my blood at this point, considering that you're fighting a downtrend. But that would be the stop. If you get a compelling drop into the US Open and another spike, another failure, another long wick candle, fade the low and look for a little bit of recovery. Again, nimble on the way up, guys. The broader trend is still lower. Now, if we do see, like I said, that downside break from here, there's room down to 95.42 or 94.52. Excuse me, I'm dyslexic here this morning. And that would complete basically 100% extension from the decline off the highs. So there's a lot of room if we break this key level. Questions on Swissy? So with that in mind, Marcin, your question on Euro Swiss. I'm going to take a quick segue here. So we looked at Euro kind of coming off resistance. Look at dollar Swiss kind of coming off support. I'm not sure what you're looking at with dollar Swiss, but let's take a look. This will be number 4. Excuse me. Euro Swiss. All right. Here's the daily chart. Okay, here's last year's open. Here's this year's open. So a nice divergence signal, right, into the low. Price action lower, low, lower, low, lower, low. Oscillator, series of higher lows. It's a very not exciting trade, Marcin. So I'm gonna just give you my honest opinion. Looking at this right now, if you put a pistol to my head, I'd probably think you get a larger recovery, but it's still within the broader downtrend. So the big zone for me, let me take a step back. The big zone for me, if we take this back into a weekly chart, is this part right here. These are my favorite trades. 618 retracement off the low, 100% extension off the high. These tend to be very strong inflection points. And if we look back in price right along this zone between 105.50 and 106.30, this 90 pip range or so, 80 pip range. Look, you got the lows from back here in February, you got the lows from June, you got the breakout that you made in July of last year, the June opening range highs, all of it comes in this 80, 90 pip pivot zone. So it's huge. I'd be looking for something right here as far as an inflection in price. Now, again, take this back into the daily chart, looking at it pretty near term. I think you're going to see a lot of chop sideways action to lower, right? You might come into the 105.50 level. That would be a more compelling level to get involved in this, certainly not only from a lateral level, but also from a slope standpoint in time, like later this month. If we get another drop, maybe that would be a little bit more compelling for me. If we were to pop through the median line, sure, at that point, I'd be looking at like a near-term setup, something like this, and it would take you the 38.2. Whoops. Right? Would take you to the sort of the upper parallel, somewhere like that. Might be a sort of a breakout play, but even on a rally into one of these regions, you'd be looking for a resumption for the downtrend. So on a trade like this, I call this the grandpa trade, Marchin. A lot of times, just as no offense to any grandpas out there, but it's just a very slow burning trade. Very slow burning trade. The ATR is minimal. For me, you're trying to squeeze water from a rock, right? There's more opportunity elsewhere to kind of shift your attention, in my opinion, Marchin. But just a quick recap. I'll revisit this if you think there's something more compelling, but looking at it kind of just on the broader scale, I don't see anything that's kind of that would get me excited to get into anything just yet. All right, knowing the direction is only 50% of the game. It's all about the setup. And from a volatility standpoint, an ATR standpoint, and a trade standpoint, where we are in trend, kind of right in the middle. I don't know. We'll have to revisit this. Okay, so that's a nice little surprise there for Euro Swiss. Let's take a segue back to dollar yen. Here's number 5. The abomination. Here's what it looks like, my friends. So the big play here is that we're coming into the first major area of support. Here's what dollar yen looks like on the weekly chart. We saw this break. We talked about it, guys. This was the break of a multi-year downtrend slope resistance. Classic dollar yen. When I call this thing the abomination, all the joking terminology we have for it, this is why, guys. It's earned its name. People probably got ripped on this, thinking, "Oh my goodness, this is a multi-year breakout." I was one of them. I didn't get involved because dollar yen and me are typically estranged unless the setup is super, super clean. But that looked like a breakout to me. It looked like a breakout of uptrend resistance too. That should be the most accelerated part of the move. What happened? Following week, we took it all back. And in fact, we covered the entire yearly range with that drop. So look, that drop is now testing the 618 retracement of the entire rally off of last year's low. That's 107.42. If we're going to see a bounce, that's the level to look at. Near-term resistance at the yearly open, that's 108.62. We've now covered this entire range this week. Look for a break of this immediate range for guidance. 107.40 into 108.60. A downside break would have you exposed down to 106.11, 106.25. That's last year's low week reversal close and a 786 retracement. A topside breach, you're exposing 106, 109.68. Remember that level? Talked about it right into the start of the year and into the close of last year. It was in 2019 objective yearly open. Converges on slope. So again, the level's super clean. We just need some Momo to get this thing going. Here's dollar yen on the daily chart. So this newly added pitchfork off the highs looks pretty clean. Okay, you got a decent pivot at the 75% line, but here's the 25% line converging on that 618. Really nice inflection, 107.41. We gapped right into that level into the open of the week, filled the gap, tested last month's monthly open, and here's the pullback. Look for the immediate break of this. It's really 108.60, guys. Into 107.42. It's the same level here. Questions? Here's dollar yen on the intraday. And here's what it looked like last night. So again, there's the daily. Oops, that's Swissy. There was the daily. We rebounded strongly off that region, right ahead of the Asia Open. We were trading right into 108.42. And then we just came right off that level. We're still sitting in the weekly opening range right above support. These tend to be good plays. Okay, so you have a test of the opening range highs. You have a test of the opening range lows. The opening range lows for the week is at support at 107.42. So if you downside break, look for the resumptive move. You're looking for 106.48, 106.11. If it breaches the opening range high, I wouldn't really want to get too involved on the long side. I'd be looking for inflection off of one of these two levels, possible exhaustion, possible re-entry on the short side. But yeah, support, 107.42. Look for the inflection off that region. Here's the 240 on dollar yen. Here's what it looked like last night. Questions on the abomination? Okay, that is number 5. Sterling, number 6. Here is the British pound. So, a little bit of a snoozer to start off the week, but it's basically the same exact setup as dollar yen in that it's setting up a weekly opening range right above near-term support. The level in focus is not only the 2019 open at 127.53, but it's also the median line for the pitchfork that we've been following off the highs here. So here's where we ended last week with a rebound recovery right off that level. Here's again 2 tests of that slope on the median line, still holding. Look, bearish invalidation is 129. If we breach that topside region, I'd like to look for the resumptive move finally. We were looking for that here and it failed at that parallel and made a new low. That's the level we need to be to get this thing going again. All things held constant, it's still in a bearish formation from a technical standpoint. And the ideal scenario would have been a drop into 126.74. So like 2 equal legs off the high to complete a correction. It converges on slope later this week, or I guess into the close of this week, early next week. I don't know. I don't know if we get it. So for me, again, I want to be long sterling. I want a little bit more conviction on a sort of near-term low being in place. 2019 open has been a level we've been looking at, 27.53. We're there now. I want to look for a little bit more of a breakout type of play to get us going here. Here's sterling on the daily chart. Big region. Here's sterling look like into the start of the week, right? That was the support zone. We just came into it, held, still in this parallel, still below the upper parallel, still above the median line. Even if we get that another drop, you know what I mean? There's that 100% extension. I wouldn't put it past it, especially because we got this consolidation break to the downside. The drawdown to the 100% extension might be the preferred play before you try to attempt anything on the long side for sterling. So another wait and see on this one. I think you get the clarity this week, especially into the start of the month. But for me, it's trying to find a low off one of these 2 levels. Ultimately looking for an upside break of this formation. But all things held constant, you're just testing downtrend support. Don't get too excited on rebounds. All right. Any other questions on sterling? Number 6. Number 7, here is dollar CAD. BOC's on tap tomorrow. Here's what dollar CAD looks like. I'm just looking for exhaustion again. The 34.35 level was a beautiful spot to turn from. It got a little bit higher, but man, we went over this yesterday, I think, if I'm not mistaken. The pitchfork on this has just been super clean. I think this is the 618. Yep, 618 pitchfork right off the highs. Caught that high right there. Here's the downside break or the downside test, former resistance, now support. Here's the median line. Could see some back and forth here, guys. End of the day, even if it gets back as high as 35.35, I'm still looking for exhaustion. Okay, I'm still looking for exhaustion. Keep in mind, that's the weekly open now as well. So you're kind of looking at a good scenario where even if it goes to fill the gap, you're still below resistance. You still be looking for the fade opportunity. Here's what dollar CAD looks like on the daily chart and why we're looking for that position. Right, 2017 open gives you 35.35, but not only that, you're simply looking at swing high that he made back here in June, the upper parallel for this modified pitchfork off the highs from last, well, this is actually the 2018 high. You get the picture. You get the picture. Key support, still we need a move below 33 on the near term front. Bullish invalidation would be a move back below 32.70s. Basic channel support. The 50 line for the downtrend that we were following off of the 2018 high rather, all converge right here. That's your broader bullish inval level. For me, the focus right now is for this pullback in dollar CAD to make its way down below 33. Okay, here's the intraday chart. Price action's been lackluster to say the least. Here's the 120 and even the 60. Looking at this, chop fest, right? Since the open of the week, still think you get it. I still think you get it. So looking for exhaustions to sell while below 35.35. Look for a break below 33 to give us the go here. 32.68 and 32.36 initial downside targets on a break. Any questions on dollar CAD? Lots of event risk on tap this week. Again, I wouldn't even stress this slope at this point. Clean this up a little bit. I wouldn't even keep in mind, rather, we have the BOC on tap tomorrow, and then again Friday, non-farm payrolls and Canada employment figures released at the same time at 8:30 Eastern. Likely to get some more definitive price action in dollar CAD this week. Okay, SPX. All right, Peter, here's what we're looking at. So here's what we talked about for some time. I guess let me show you this first. Here's SPX on the weekly chart. Again, when we put this on the weekly chart and look so far out, we put this in log scale. And just to show you a quick reference to the levels that we were looking at, 2865 and 2874 was massive. It was a level that we talked about, ever since the turn and break below the upper parallel back here. First region that we were looking for a hang up, we soared through it. Second region was right here. It's a 50% retracement of the advance off of the 2018 lows and the May 2019 low outside week reversal. Try saying that 4 times fast. Here's the low week reversal, but it's also an outside weekly reversal off the previous monthly lows to the upside. The close of that game in at 28.75. So 28.74, 75, 28.65 was the 50. The median line for the current formations right in there. It's exactly where we bottomed out last week, right? So no surprise to see a little bit of a rebound. Where's initial resistance? Very simple. Former support. Look where we capped out so far this week. All right. So my whole point in showing you this weekly chart is this is paramount. Basically, this week's range all the way down to 28.65. This is the broader focus. If this is a legit break of uptrend support, then that should be the maximum we should advance into. Look for the resumptive move. If we make it and close back above on a weekly basis, that inflection, well then, this whole slope can be null and void. You can just drop it. So some things to consider on the weekly chart. Momentum coming right off of 40. Keep that in mind, right? Strong uptrends, momentum will tend to find support at 40. So we want to see that change in behavior, a break below 40 on a weekly standpoint to suggest that the momentum profile has also changed. Okay, so things to really pay attention to this week. SPX on the daily chart looks like this. Okay, so that's the weekly. We've recovered, and right now we're testing this resistance. Daily looks like this. Talked about this inflection at the 30 handle, essentially 129.91. If this breaks, look for recovery back into former slope resistance or former slope support in that resistance. That gives you 30.63 and 30.92. Here's 30.92. I removed 30.63 just to keep the chart clean. It's the 50s right here. But we've basically made it right here. We're trading right here right now, right? So look, looking for resistance, looking for exhaustion. If we push higher, 31.25, even 31.80. Okay, it's the January low. It's also the 618 retracement of the yearly range. That's max. That's my my bearish inval. If we get 31.89 or above, guys, you're basically looking for a resumption. Don't even try to fight it. But on the extent of this type of magnitude, now remember, one of the largest weekly ranges in history, certainly the largest single daily loss that we've seen since the financial crisis. So sure, you're going to get some kickback. Not only that, if you look at the financial publications today, guys, you're going to see everyone saying, oh, well, the markets think the Fed's going to move in. That's why they're rallying. Sure, whatever reasoning they want to come up with from the quote unquote fundy side, right? At the end of the day, it was an extended drop way into oversold territory. It was a massive multi-day decline, one of the largest that we've seen. Yeah, you're going to get some of that back and fill. And here we are. Here we are. So I don't think this is done yet. Even if we get a little bit more kick to the upside, I think you're still looking for exhaustion. Don't necessarily want to target new lows, but I do think you travel more lateral here. More lateral. Don't forget, we're only a week and a half away from the Fed, and there's all these expectations that they might come out with an emergency cut. Today, specifically Super Tuesday in the United States, where over a third of the delegates for the Democratic Party are all online. So certainly, the whole debate on whether you get a Bernie Sanders type of play or you get a Joe Biden type of play, which will be a little bit more calming to markets. Obviously, Bernie's a little bit more, the revolution calls are frightening to markets for sure. So that could play into market sentiment today. At the end of the day, I still think you look for an exhaustion rally on the SPX. All right, only a rally through 3189, 3180, this region here would put me back on the constructive approach. As it stands, I'm basically looking for exhaustion like right here in this zone. Here's the intraday chart, Peter. Oh, I'm not done yet, buddy. He says, thank you, great. No, we've gotten a lot more intricate with the S&P since things are started breaking off. Here's what the intraday chart looks like, and this is what I've been following. So here's what we wrote about on the first of the month, right into the Asia Open on Sunday. I was telling you guys, man, it's coming off a downslope support. Now, you never really know if these downslopes are in play yet until you get some more inflection off them. But boy, worked out pretty well, right? So the October low, that ended up being the low. We were looking for recovery near 3060, near 3092. Here's 3092. Okay, so if we're gonna hold, this would be a great spot. If we break higher, again, a spike into 3125 or even 3180, 3190 would still have me looking for exhaustion. Does that help, Peter? Make sense? I'm sure this is going to sucker in a lot of people, so just watch out. He says, yes, all right, right on. Okay, last two real quick. That is number 7, number 8, and 9 will be gold and crude. So here's gold. I'm usually a huge advocate for this trade, all over it. At this point, I think you have to be really weary. Here's what it looks like. Well, let me show you what we've been looking at. So you guys know on the gold trade in general, we've been looking for exhaustion, right? Looking for that pullback. It's been a very tough trade since the beginning of the year, trying to look for that pullback. Massive outside weekly reversal last week off of, I guess last month too, off of confluence resistance. Now on a closed basis, guys, this is gonna freak you out. Look at this. Look at this. This is basic slope resistance of the same gradient and the broader pitchfork, the 75% line, which caught the lows, I'm sorry about that. We were on log scale, sorry about that. Upslope resistance, right? Here's what the candle looks like. That's the confluence zone that we were looking at. Overshot up a little bit, massive outside weekly reversal, takes you lower. We're sitting at 1586. We closed right below 1586. This thing closed literally at 1585. So, I was thrown off into the start of the week because I really wanted to see, well, if it was going to close below 1586, we'd look for the pullback. We closed at 1586. This could go either way. So look, I'm looking for exhaustion ahead of 1625 if we are moving lower. Okay, on a weekly standpoint, that's going to be basically this pivot low that you made on the back. What was that? The 2012. So after the high was made, and the intraday, here's the daily chart, basic slope support, you can scratch that at this point and focus on this one. And that, whoop, keeps the support focus on this region. Okay, here's the intraday chart. This is what you need to focus on. Okay, so I know this pitchfork's a little messy with this break here, but remember 1586 was a huge zone. So just as we looked at 1586 on the weekly chart, just as we looked at it on the daily chart, here's what it looked like on the intraday. That pitchfork that we were following, the lower parallel literally converged there. Look at Friday. All that mess, right? All that messy price action, but we closed right there. Start of the week, make a 38.2 retracement, pull back. Where did we fail? Right there again. So my point being in gold, while broader scale, we do like it lower, even if it breaks higher first and corrects up as high as 1625, which is what I told you on the daily chart, right? It's the 50% retrace. It converges on the upper pair. Even if it rallies this high, I'd still be very cautious. I'd still think that the risk still remains for a larger washout before this thing resumes higher. Look, we're still bullish gold on the broader term. You guys know the longer term prospects haven't changed, but the area and the time of which this turned was important, was critical. So both in price and time, the yellow metal is certainly at risk, vulnerable for a pullback. Broader picture still constructive. All right, so if we break 1585, point being, you're looking for a deeper drawdown, like 1552, 1535 would be targets on the downside if we get there. Looking for exhaustion ahead of 1625 on the upside if this thing is heading lower. Any questions on crude? And with everything that's happening, guys, excuse me, any questions on gold? With everything that's happening, you know, a lot of you are probably asking, and I've been getting a lot of emails saying, hey, Mike, is gold gonna reattain its haven status? You know, we got the coronavirus, you've got elections coming up, you've got, you know, all this event risk and all these major headlines in the markets. How come gold isn't catching a bid? Guys, let's not forget what's happened, okay? In the last, like, what, 3 months, we've seen a rally of what, 17%? Come on, come on. Even if gold pulls back 10% off the highs, 15% off the highs, no one's saying it's a bear market. But people will fall in love with this concept, right? And irrespective of where price is, irrespective of where you are in trend, oh, things are concerning, gold should be moving up. Things don't work that way, right? You have to keep in prospect of where we are in trend and where we are in price. These nominal ideas of just going with thematic type of trades, man, that's like newbie 101 mistakes. We're not going to take that route. So stay focused on price action here. Again, the risk remains for a deeper setback below 1625. Ultimately, we do want to reassert the long side for gold. All right, last but not least is crude. Also big decline there, coming off of nice clean support. I'll have a weekly chart on daily FX a little later today, guys. And this is the chart I'll be putting on there, is this one. Here's the weekly chart for crude. So 45.23 was a region I've been talking to you guys about for a while. You guys all know that region well. It's the 618 retracement, the advance off the lows in 2016. It's the 618 extension of the decline off the highs in 2018. It's also the 2019 open and pretty darn close to the 2018 low week close. All of those levels I just noted at 45 to 45, 45, 23 also converge on basic slope. This red line here is a parallel of the same gradient that we were following from the 2015, 2016 lows. Topside breach gave us that whole 2018 rally. Here's the upper parallel still offering resistance last year, Parallel, one high, one low, one low. Here we are again. In case that wasn't enough, current operative downtrend support, the modified pitchfork we've been following from the 2018, this year's high. The median line, take a parallel, extend it off the low that you made in June, right there. Okay, so I'll be putting this on daily effects, but just keep in mind the focus, what we'll be talking about is right here. On a weekly close basis, we close sub 45.23. You're looking for 43, the 28.17 low week close. You're looking for a resumptive move down towards essentially 37. Okay, 36.91 is 786 retracement. The lower median line parallel for that formation, and the current operative 25% line. Okay, or 50 line of this decline. The 25% line's right there. So for me, it's all about this immediate region right now. Here's what crude looks like on the daily chart. So there's that same slope, right? There's that 25% line. There's the spike. There's the pull. 49.63, near-term bearish inbound. Okay, so I want to see failure into this region if we're still moving lower. Right now, that's the risk. That's the risk. Keep in mind, this is also pretty darn close to the February opening range lows. The February open comes in near 49, 49.80, right? That's your key resistance region. And this slope has been pretty good. So parallels have been very good in catching lows, break, inflection, acceleration is exactly what you want to see. See how this reacts up here if we get it near 49.60s. Here's the intraday chart. So remember this setup, we were trading within the confines of this formation, was really, really clean. We talked about 54.73. This was our bearish inval. If this had broken, I thought we were gonna get much larger correction in price. Didn't. Really nice inflection in price. Again, former swing lows, former swing highs, a 50% retrace, slope resistance, beautiful spot. The break below uptrend support was the tell. Took out all those targets right into the lower parallel. So looking for exhaustion, still think you can get a little bit more upside on this, but looking for exhaustion into that median line if this is going to head lower. All right, and that's crude. Any other questions or trade setups? Do let me know. Again, you got the BOC on tap tomorrow. Watch dollar CAD. Heading into the end of the week, we'll go over the levels for non-farm payroll on Thursday, guys. We'll hit all the dollar crosses again. Aussie, if you have a second, thanks. Hey, Patrick, I got you. I've been leaving Aussie and Kiwi out on purpose, guys. You know I love these trades. They're typically my favorite pairs to trade. I just haven't gotten a good fix on this. So, Patrick, this is the same setup I've had for weeks. We haven't changed anything. It's just, how we would trade this last week, I don't know. At the start of this week, we gapped lower into the open and filled the gap. So I didn't really want to take a stop with a 40 pip loss against that low. We were already far off it. So look, again, I want to be long Aussie, but it's not just about the direction. It's about the position. So I haven't personally got a chance to get in. I haven't been able to identify and pinpoint entry. I'm kind of pissed because I've been waiting for this rally seemingly forever. But I think we just have to wait for a little bit more of a back and fill type of move here before we start to try to jump in on Aussie. On its face, here are the levels I'd be looking at. Basic retracement of the advance of the decline off the yearly high. And then here, I'm looking for structure. I want to see some structure to the upside. Yeah, this is gonna be super tight now, but you get the picture, right? Yeah, any way you slice it, it's all about 66.60. So look, basic slope resistance, we don't want to ignore it. That's gonna be right here. Near-term slope puts the a parallel just right in 66.25, but 66.60 is the inflection point. That's the level we were talking about, and the whole way down, this is where we start to get bullish, remember? And then it failed at the upper parallel, and we're like, all right, another test of the parallel support, but let's look to trade against 66.60. Man, when that broke, that's the conviction that you want to see in your levels. When that broke, there was no wishy-washy behavior. There was no questioning it. It just gave out, and it was a one-way trade ever since. So look, I mean, this is the first level you want to see sort of beat that basic slope, but I still would need to see an inflection through 66.60, the devil's number, try to get through that top side and validate the reversal. Does that make sense, Pat? He says, thanks so much. Have a good one. Hey, you too. Great seeing the room, sir. And just as, you know, while we're at it, let me just jot these down that we covered these, Aussie. And just a real quick look at Kiwi. Pooja, I know you, Iman, you guys tend to like this pair as well. Just want to note that we came into the lows and it held. So here, it's not 100% extension. It's just the lows, 100% retracement right here from the low that we made back in October of last year. So we kind of probed into it, bounced. I don't know. I just want to see a little bit more of some sort of breach of downslope resistance. Unlike Aussie, which is next to that slope, a longer term slope, Kiwi doesn't really have anything like that. There was this, which I was looking at this morning, but I kind of just looked at it and gave up real quick. Here's what it looks like. So that could have been a third tap. Still puts you a little bit farther away above the weekly opening range. So even if you get a break of the weekly opening range, you're really not going to know if you broke that slope for a while. I think we need to wait out Kiwi. I think we need to wait out Kiwi. Guys, I try not to bring your attention to a trade unless there's clarity there, because these trades, when they're so far out and the technicals are so messy, they could just wreck you. And it can make a really positive month or quarter go negative just by trying to mess with a trade that's not really prepped yet. So I'll bring these to your attention when I think they're warranted. Right now, I don't know what to do with it. Pooja says, no idea what to do with this. Still looking bearish, though. I'm with you. I'm with you. I still think if this rallies, you get failure and it tries to make another probe into a low. I'm with you on that. But what those levels would be, or where the formation even gives you slope, it's just not warranted yet. So Pete, I hope that helps on Aussie, or Patrick, sorry, I hope that helps on Aussie. Here's what Kiwi looks like. I'll bring these up. Don't worry, guys. I track these daily. I look at them daily. Even if I don't talk about them or write them in my daily update, I'm only writing to you guys when I'm actually like getting involved in. But I hope we get further clarity on Aussie and Kiwi soon, because I think these guys are primed for some moves here. All right, guys, best of luck trading. I will see you all on Thursday. Again, watch the BOC tomorrow. We'll give you an update on the NFP Fridays then. Till then, best of luck trading. Cheers.